Karen Cho joins us right now from London with more on this developing story. Karen, good morning.
Good morning, Becky. Yes, the central bank here dragged off the sidelines, intervening in markets, in particular the gilt market. There'd been a lot of chatter swirling about the type of intervention we may see from the Bank of England, if any. But at this point, we have seen fairly dramatic action. Let me just spell it out for you. The Bank of England has said that it will buy as many long-dated government bonds as required between now and October 14. So this is a window as it looks to stabilise financial markets. It's added that it would postpone next week's start of its gilt sale programme. This was the beginning of QT, quantitative tightening. So that has been kicked out into the longer grass now as it tries to intervene in markets. The language has been dramatic and reminds me of the financial crisis as we talk about some of the words used today by the central bank. Were dysfunction in this market to continue or worsen, there would be a material risk to UK financial stability, according to the Bank of England. Again, this language, as we talk about dysfunction and financial stability, very much similar to financial crisis language. This would lead to an unwarranted tightening of financial conditions and a reduction of the flow of credit to the real economy. The Bank of England says that its purchases are designed to restore orderly market conditions. The purchases will be carried out on a whatever scale is required to affect this outcome. That's important as we talk about intervention by central banks. They've been concerned that if it did intervene, would it just be a drop in the ocean? Would the central bank lose any battle against markets? And don't forget, market speculators have lined up against UK assets in recent days. So dramatic language by the central bank here. Now, in terms of those yields, take a look at the market reaction. The 30-year British government bond yields had climbed above 5% early on for the first time since 2002. There's been a pullback of sorts. We've seen about 20 basis point odd move in some of these longer dated yields. So there has been an impact based on this intervention. And the Bank of England, though, is still saying it will keep its goal to reduce its £838 billion of gilt holdings by £80 billion over the next year, despite the postponement of that QT program. And I think also interesting that it's saying this is a time-limited window. So it's not talking about ongoing intervention, although already the immediate reaction by some of the rates strategists that we've spoken to is saying this could just be the beginning. So they are questioning that window already first up. The other point is that we just have jawboning on interest rates at this point. The MPC says that they will not hesitate to change interest rates as much as needed to return inflation to the 2% target sustainably in the medium term. So that is fascinating because we only had a 50 basis points move last week by the central bank. It was not the 75 basis points that the market had anticipated. Already before that move, many were saying it would be tone deaf if we didn't get 75 basis points. We didn't get that, and we haven't importantly had that intervention on the interest rate out of cycle. So that is why we're possibly not seeing as much impact on the pound. Becky, back to you.
Karen, thank you very much. I mean, this is pretty significant moves here.
Is it good for us? I mean, it just makes the dollar potentially stronger. So they're blinking a little bit. We were hoping yesterday,
in a big way.
Right? We were hoping yesterday that some of the comments from Charlie Evans, where he said, "I hope we can avoid a hard landing," still meant that maybe the Fed doesn't necessarily need to go 3 or 4 more 75 basis point hikes. But so they already they're already not going to no tightening.
This is done to restore orderly market conditions.
Yeah, but
when
they're
you see
blinking.
Moves of 32 basis points in a day.
They're going to get inflation to 2%. How is this something that allows them to?
Well, that's why they're trying to walk a very fine line with this. They're saying that it's going to be a limited window, but at the same time, this is going to be carried out on whatever scale is necessary. Those are contradictory sort of statements that are out there. They're trying to dip their toe in. They're trying to do what Hank Paulson used to say, which is you don't have to use the bazooka if they know it's in your pocket.
Right, but I'm not sure. It just makes the dollar. It makes our move to have all this firm resolve and tightening. Once again, it isolates the UK and the Europe. They've moved too slowly, and here it shows that they don't. They're folding already.
But they're also dealing with the second. They're also dealing with the second huge crisis, which is natural gas prices and energy prices there that are so much more expensive.
You remember a guy who broke the British pound back in the early 90s? Yeah. With Soros.
George Soros. Yes.
No, Stan Druckenmiller.
Oh, yes. Stan, you're going to be talking to today, too.
And the pound is that issue here. So it's an amazing day to have. Shepard Smith here. Thanks for watching CNBC on YouTube.